Well, let's talk about that question right now. First, I would just want to mention the specifics of the job openings, which we're showing on the screen as well, rising to 7.367 million in February. That's above the estimates for 6.9 million. It's also an increase of 268,000. So there are jobs out there, at least if you measure it by the so-called JOLTS number, those job openings. Let's bring in Young Yu Ma now. He is Chief Investment Strategist at BMO Wealth Management US. Young Yu, thank you for being here. How are you thinking about this question, right? Basically what Miles was just talking about. We've got these economic numbers seemingly showing a lot of strength, consistently beating estimates, banks consistently raising their GDP forecasts. Is that going to equal a higher market?
Well, I think what Miles said makes a lot of sense. The economy is not the stock market, but overall, that general trajectory should still hold. Will we get the same type of acceleration in the stock market that we're seeing in the economy? That's very unlikely. But in terms of the market being a discounting mechanism, looking forward to 2022, we still expect to see above trend growth, and we still think that portends for a favorable position for the stock market, even if we don't see the type of acceleration in the equity market that we're seeing in the economy. It's going to be more muted, I think, as Miles points out, because we do have crosswinds to deal with.
Young, something you guys have written about, over at BMO, and I see, Brian Belsky had a great note earlier this week talking about the market entering a new bull cycle, that this isn't just a one-year phase. We're in a new part of the market's overall life cycle, I guess. What are clients saying to you about that kind of idea? I think it still is very counterintuitive to folks that this is year one of what's likely to be a multi-year process. People might still be benchmarking, to the spring of 2020. I'm just curious how you've kind of talked folks through that idea of us entering, a new decade for a new bull cycle.
Well, we do think things are set up relatively well. And what's important to keep in mind is that we went into this downturn, into the pandemic, without major imbalances in the economy. So really, when things turn around, if we think of whether it's the dot-com bust, the financial crisis, it's when major imbalances start to build in the economy. And that takes a number of years. That's not something that happens overnight. It's not something that happens even in a few quarters. So we really have a nice setup. We have a lot of stimulus. We still have a very dovish Fed, and we still have low interest rates. So before imbalances can start to build, there have to be a lot of developments that take place. So we think there's a lot of runway. Whether that lasts a decade or not, we'll see. But we do think there's a lot of runway ahead.
What do you think the impact of a global minimum tax would be on the markets?
Well, let's see what actually happens, right? I think there's some extent to which that's somewhat wishful thinking. From the U.S. standpoint, Janet Yellen mentions the desire for global minimum tax. Whether or not that's uniform or at least you can get enough countries on board to make that stick is entirely another story. In terms of the impact, it's probably muted. There's not great consensus among these things for these things across countries. So, I think it would be somewhat of a patchwork that would try to plug some gaps here and there. I don't think that's the biggest thing that the market faces right now. I think that's less of an issue than the direct tax increases that are going to happen, that negotiation in the U.S. And ongoing negotiations for some of the stimulus and tax increases that will come, or at least potentially come later this year.
Let's talk about risks more broadly as well. In your note to us, you talk about three of them: potential for spiking bond yields. There's been a lot of talk about that. Of course, rising inflation and cost pressures, ditto. Your last item, speculative activity increases, and you're talking about the things that we've been watching happen this year: IPO and equity issuances, SPACs, et cetera, NFTs. That seems to have come off a little bit. And so I wonder if that risk in particular you are less concerned about at this point, or you think that perhaps something even like Archegos and that unwinding illustrates that there are still some underlying frothiness or other kind of counterparty risks in this market.
I don't think the Archegos unwinding appears to be a systemic risk, or that is indicative of other systemic risks. But in terms of some of the other sort of speculative activity coming off, yes, in some areas, but not necessarily in all areas. You can see there are a lot of companies that are still very eager to issue equity, so that equity issuances are quite robust right now. Even trading in penny stocks, yes, it's come off a bit, but still higher than is typical. So we see pockets of speculative activity. We don't think this has yet reached a concerning level on a market-wide basis, but if those continue and we have continued equity issuances, companies really looking just to take advantage of what seem to be high stock prices by flooding the market with equity, we think that would be a challenge for the stock market if that continues for a few quarters, because what's really held in the stock market and provided support over the past several years has been this idea that stock buybacks were greater than equity issuances. And that's really allowed for a decrease in the equity base and for the supply and demand really to tilt the way of demand being favored. But now with more supply coming into the market, if this continues for a few more quarters, I do think that's something to keep an eye on, and it could lead to somewhat of concern in the market.
That's a really interesting way to look at that equation, the buybacks versus the issuance. Young, we will keep in touch and we'll check back with you to see if that trend does continue and what else is going on in the market. Young Yuma is Chief Investment Strategist at BMO Wealth Management.